Bloomberg Audio Studios.
Podcasts, radio, news.
Hello, Merryn Talks Money listeners. It's Merryn Somerset Webb. We are bringing you something very special over the next week. Recordings of the conversations I had at Panmure House for the Edinburgh Fringe Festival. Now, for those of you who don't know, and I'm sure there aren't very many of you who don't know this, the Fringe is a 3-week arts and culture festival that began in 1947 and takes place in Edinburgh in Scotland every August. For the past few years, I've been hosting conversations about markets, economics, and investing from one of the most special locations as part of this festival. I do it from Panmure House, which is the last home of Adam Smith, philosopher and father of modern economics. It's where he completed the last editions of his bestsellers, The Theory of Moral Sentiments and The Wealth of Nations. Top reads, both of them. This year, we did a 4-day run in mid-August, and we are bringing you the slightly edited conversations from 3 of those days. For this panel, I spoke with Bloomberg senior reporter John Stepek, James Ferguson, who is the founder and partner at MacroStrategy, and Ed Conway, author of Material World, A Substantial Story of Our Past and Future, which is an excellent read. And if you haven't read that, go out and buy it right now. It's fantastic. Enjoy listening. Thank you for coming. I know there's an awful lot of shows at the festival and there are a million things you could have been to which are billed as comedy and might have been more amusing than this. So we're very, very grateful to you for coming here today. Thank you. The way this works is I ask all my brilliant guests to come up with their favourite Adam Smith quote, although that's difficult because everyone has a lot of favourites. They're one that is both their favourite and most relevant to today. They give their quote and then we talk about the context of that quote, why they like it, why it matters today, and then we talk about all sorts of other things that we didn't intend to talk about, but which kind of come up as we go. So each one will do that, we'll discuss it, then we'll move on to the next one, and then in 40 minutes or so, we will have questions and someone will win the book, and it'll be great. So we are going to start with Ed, who has broken the first rule of the show before it even starts, the first rule being please have a short quote.
It wasn't really me that broke it, I think that was Adam Smith. Because he was not known for his brevity.
He wasn't, he wrote very, very long sentences.
And as a result, my quotes, if the audience can see here.
And that's what I mean when I say we may not have the full 20 minutes of questions.
So that's our hour, isn't it? Do you want me to, shall I read it? I'll do a bit.
I tell you what, why don't you pull out a bit of the quote?
I'll pull a bit of it out.
And then, I mean, you can read, maybe.
Okay, so it's from The Wealth of Nations, and it's about woolen coats. The woolen coat, for example, which covers the day labourer, as coarse and rough as it may appear, is the produce of the joint labour of a great multitude of workmen, the shepherd, the sorter of the wool comber or carder, the dyer, the scribbler, you get the idea, it kind of goes on a bit, the dyer, the scribbler, the spinner, the weaver, the fuller, the dresser, with many others, must all join their different arts in order to complete this homely production. How many merchants and carriers besides must have been employed in transporting the materials from some of those workmen to others who often live in very different parts of the country. I'm going to stop there because you get the idea. So when I started kind of getting interested in economics, there was this essay called I, Pencil by a guy called Leonard Read, an American economist, and it was all about the story of a pencil and how a pencil is made. And it's fascinating because in the course of this essay you learn how, that actually this is a very complex thing to make a pencil. You need the wood that's chopped down from a tree. In the US, you need the lead, the graphite that comes from another part. You need the metal that becomes the bit that attaches the eraser. You need the rubber and so on and so forth. And the kind of punchline of this is there is no single person who knows how to make a pencil. And I remember being quite obsessed with this. But of course, as with so many of these themes, Adam Smith came up with it first. And actually, his point here is that the complexity of even supply chains back in the 18th century was way beyond what any single person could fathom. And each of us carry around or wear, in the case of woolen coats, we carry around products that are made by so many different people in different parts of the world with such complexity. And we just don't spend much time thinking about it. And it's one of the wonders, I think, of the modern world that the market often can help us produce these things which are just amazing. And so, I'm going to try not, as much as I can, not to puff my book in the course of doing this, but it's hard because it's been ingrained in me in the last year. So one of the things I try to do in that book is to do the same thing for a smartphone. And it's obviously impossible. But even before the semiconductor that becomes the heart of that smartphone, is actually made, the silicon that you need to make that goes through this incredible transformation, goes around the world multiple times, it gets kind of vaporized, turns into all sorts of different things. Hundreds of different companies are working on it. These things are just hidden away. And I think the more that we spent some time thinking about how stuff is made, how it got to us, then the more A, I think we would appreciate the stuff, the more B, I think we'd have wonder in the world around us, because it really is kind of amazing what's happening inside our devices. And also C, I think we would understand a little bit more about the kind of compromises that happen along the way, because to make anything involves quite a lot of emissions, it involves a lot of energy, it involves a lot of effort. And in economics, we're not particularly good at kind of embedding those things within each of our different models. There's this vague talk about externalities, but the closest I've come to kind of actually trying to understand the challenges facing us as we do net zero, and also just understanding the wonder of the world, is to think about an item, a product, and what it takes to make it. So, you know, Adam Smith, I think, had that kind of principle early on. It's inspiring to think about how things are made and how many people are underneath that kind of hidden backstory of all the things that we're touching.
I mean, it kind of slightly frightening, doesn't it, when you think that there isn't a single person who knows how to make a whole aeroplane or knows how to make a whole car.
No, but they don't know how to make a pencil. And so let alone, you know, the plane or the semiconductor or all of these other things. But that's the wonder of economics. And I think that's what Smith was trying to get across. This is quite an early quote in the book. This is amazing, because this is the human story. It's how we cooperate to make things. And so he was talking about a woolen coat. At that point, you know, wool was one of the great industries of this nation. But it goes today, and I think we need to tell those kind of stories in an inspiring sense, but also in a kind of realistic sense about there's some challenges there about carbon emissions, about water use, all of the other things as well.
It's the drive to net zero that really made you start thinking about this, and is that one of the things. And it becomes very interesting when you look at it, because we listen to politicians speak and we listen to activists speak, and they make it sound so incredibly simple. We should just do this. We should just do this. But in fact, if you read your book, the underlying, the mining, the materials, the energy required to produce an energy transition make it much, much more complicated, much harder than most of the people who discuss it understand.
Well, I mean, in a way, actually, it's the other way around. I didn't intend to write a book that touched on, you know, net zero and all of that different stuff. I didn't intend to get into covering the energy transition. But when you start to think, I kind of just wanted to understand how a smartphone is made. You know, how the different bits and pieces actually came together, you know, what it actually takes. But when you go down that rabbit hole, you just see that making everything involves an enormous amount of energy, it involves an enormous amount of carbon emissions. You know, to make the semiconductor, just to make the silicon that comes out of the ground, you quarry some rock, you turn it into what's called metallurgical silicon. By the way, there's a whole load of other processes before it becomes a silicon chip. But just that process, you have to throw it into a furnace alongside coal. You know, when people are kind of tweeting about, oh, we really need to have fewer emissions, they are doing it on an item that has coal in its production. They're doing it on an item whose battery literally has oil inside it. And understanding those complexities and realizing that it is everywhere just made me think, well, I can't, there's no way of describing the current world, which is the idea, without touching enormously on this undertaking that the country, the government has signed up to. By the way, does anyone know how many hours of debate there was in the House of Commons before we officially signed net zero into law? Actually, zeros, no, it's one. It was one. It was actually 88 minutes. 88 minutes to debate the single most consequential, because I think it is, the single most consequential thing, law that we have ever agreed to. And then it was signed. There wasn't even a vote. There was no division. It was just and then it went through because it was done as a statutory instrument. We signed up to these things, I think. Having then gone into these kind of various rabbit holes, I realised that we have just not thought at all about what this involves.
And this is because one of the things you talk about whenever we discuss this is everyone believing they live in an ethereal world and forgetting that they really live in a material world. So that debate was all about something theoretical without a thought of the practicalities behind it.
And it's very easy if you live in, and I inhabit that world as well. You know, I live in kind of London. I spend a lot of time talking to policymakers and think tank people and finance people and economists, and it's just ideas. And we kind of think that physical things don't really matter for ideas. And that just couldn't be more wrong. You know, any communication that we have goes these days in the internet via some fibre optic cable. And what's that fibre optic cable made of? It's made of glass. And what's that glass made of? It's made of sand. And understanding that physical kind of set of foundations that underlies everything. It's like the GDP that we kind of think of. I don't want to get into slagging off GDP because that's very...
Well, we slag off all sorts of things all the time.
But gross domestic product, it gives this enormous value because we pay an enormous value and it generates enormous value to things like social networks. But you wouldn't have any social networks without the fiber optic cables. You wouldn't have any social networks without the servers that you need to provide that. You wouldn't have social networks without the energy that we need. And the whole point is that GDP is like a big inverted pyramid with all of the big stuff, that kind of constitutes a lot of the value at the top. And everything is balanced on this tiny, precarious little bit of GDP, which technically speaking is only a few dollars, but it's the stuff that makes everything else tick. It's the concrete, it's the materials, it's the fiber optics, it's the semiconductors. They're worth a bit more, to be honest with you, these days. But still, that stuff is relatively small. And all we kind of tend to think about a lot of the time is the slice at the top. But without the stuff at the bottom, the whole thing just falls. And we I think, particularly in this country, we need to think about that quite importantly because we don't make much of this stuff anymore, for better or for worse, and it matters because without it, we're all screwed.
I mean, we need to think about all the dirty stuff at the bottom.
And it's very dirty to make it all.
Yeah, it's all filthy. Yeah. We were talking about rare earth metals, etc., on a podcast recently, and saying that if we really, really believed in net zero, we would have to dig up most of Cornwall.
Yeah.
And get out the lithium.
Well, there's a lot of lithium. There's a lot of copper. There's a lot of copper. In fact, some of the grades you find of copper in Cornwall are better than some of the grades that you get in Chile, which has the world's biggest reserves of copper. So technically speaking, we could go there and mine the hell out of Cornwall and be probably copper independent from the rest of the world. But
we're not going to do that.
We seem reluctant.
NIMBY's not working on it.
Seem reluctant to.
And personally, I reckon we could do without Bodmin more, but maybe.
Nonetheless, it's protected, so no chance. And that's one of the issues I think we're coming into at the moment, that our ability to make all this amazing kind of stuff happen is it's limited not so much by the geology. There's no shortage of any of the stuff we need. It's limited by our reluctance to go there and get it, and also to some extent by our expertise, because we're forgetting how to do this stuff. One of the world's most important mining colleges in Cornwall, Camborne, they've shut down one of their courses for the last few years because there's not enough people who want to go and learn about mining. And
this is absolutely extraordinary, isn't it? Because we're now at a time, anyone got kids who are university age, just done A-levels looking for courses. And it's amazing how few go into this. And you hear it over and over and over that they have trouble filling the geology courses, the mining engineering courses, etc.
Because they want to save the environment.
Yeah, but that's where the money is, actually, by the way. Tell your children to go into the oil industry.
Yeah, that's how you save the environment. Yeah. But by understanding how to get stuff out of the ground and turn it into another kind of amazing thing that will help change the world. That is how we do it. And right now, particularly in this country, we're kind of forgetting about this.
But we've forgotten about it across the West. I mean, James, bring you in. We see this in the stock. I know, sorry. We see this in the stock market, right, where we see the mining sector in the US and in the UK smaller and smaller and smaller section of the market, and the big tech companies a bigger and bigger and bigger part. So you can see people adding value to the ethereal world and no value to the material world.
Yeah, well, but this is potentially a function of weird things in the market rather than necessarily how things are always going to be. If you have passive ETFs, then if big components like the Magnificent Seven and the passive ETF go up.
Not everyone's an investor. Explain the Magnificent Seven.
Oh, well, the Magnificent Seven was a group of 7 stocks in the US which were more than their weight in the action of the index was very, very high. So if you look at the performance of the S&P, it's gone up quite substantially, but the S&P equal weighted has been pretty much flat. And the only components that have made it go up are the biggest stocks in the index. But there's kind of a catch-22 going on here, because if people put their money into the index, an ETF, then the index has to buy more of the stocks that have gone up than of the stocks that didn't go up, which means you're compounding your error, if it is an error. We'll probably go into whether it is an error or not. Well, I'll just say one thing quickly about, so it's no longer a Magnificent Seven. Tesla dropped out, and then Amazon dropped out, and it's really NVIDIA. So basically, NVIDIA is sort of driving this whole story. But NVIDIA is precariously balanced. I thought of this when you were doing your pyramid. NVIDIA is precariously balanced on 3 numbers. It has very high margins because it charges very high prices. And because it's doing this, it's creating growth, so it has a very high multiple. But it does mean that those are 3 very vulnerable. You don't need to kill more than one of those, and it's all over. And if you kill more than one at once, maybe all 3 go. So we've built ourselves a very precarious situation that will be revealed soon, but not yet. And I think that's quite analogous to what's happening in the world of students who all think that, all you got to do is buy an electric vehicle and you're saving the planet. They genuinely probably, and even the people teaching them probably genuinely haven't thought through it much more than that. And we'll discover.
Okay, so back to NVIDIA, error, AI bubble.
The thing about AI is that I don't know anything about it. But they're telling us that they can create artificial intelligence with large language models. This is generative AI as opposed to sort of narrower. I think narrower functioning AI is fine. You give it a specific task, but then that's not really AI, is it? But once you talk about sort of wider use AI, you're basically saying, learn it from this data. What data? Well, the stuff on the internet. Go and read the internet. So they go and use these large language models and they read the internet and they come back and go, right, I know everything. And you go, okay, can you tell the difference between stuff that's true and stuff that's false? Define sarcasm. Do you know when someone's making a joke or being rude or being naughty? They haven't got a clue. So we've got this major, I think, block between what a child learns and really, we should look at young children and what they learn. They learn a language in 3 years, even though no one tells them what it is, what a language is, but they learn it. And they understand how to walk, rebalance themselves, not fall over too often. And they all the time they're looking at these. So I remember once when the earliest stages of AI, the military was trying to design software to identify foreign enemy tanks versus friendly tanks. And that was fine, except then they discovered that all the pictures of the tanks that they'd taken, which were enemy tanks, they'd taken on cloudy days, and all the friendly tanks were blue sky days. So they had this problem that the software was identifying the weather. So then they said, okay, we've got to make it cleverer than that. And then they had tanks driving through bushes. And the software's going like, well, that's a bush. And so in the end, they tore their hair out and went back to it. So AI is going to come along. In my career in finance, which is now, Merryn was reminding me the other day, far too long, we've had probably at least every sort of cycle, there's been some fantastic new mathematical idea that's going to take off and revolutionize investing. Started all the way back in 87 with portfolio insurance. And then we had, iterations of similar types of iterations ever since. And almost all of them fall down on almost always really quite basic stuff. For example, the reason why we had the collapse of sort of subprime housing securities was because they made a decision that when modeling securities, that all the data would be independent. Now, most people aren't statisticians, probably don't know what that means, but that assumption is that whatever happens today is going to be totally independent from what happens tomorrow. So you go, okay, fine. So in your world, if the market crashes today, everyone wakes up tomorrow and trades as if it hadn't. It's obviously unrealistic. It's obviously nonsense. They go, yeah, it's really hard to model otherwise. Well, okay, in that case, you should mention the fact that the model may not be very reliable, particularly not when it matters.
Ed, back briefly to AI. I mean, that is incredibly energy intensive. So that makes the whole electricity shortage problem even worse.
If you look at the kind of the domestic electricity demand and projections in the United States, it is going through the roof. It's kind of amazing. Having
been flat for quite a long time, and that's key. Electricity demand just barely
moved. Well, I think almost diminishing, and then suddenly it's kind of going up through the roof, and it's because of AI. It's because it takes an incredible amount of energy, particularly to train the AI models, but also to run them as well. And a lot of the people, they want the servers to be there. So and of course you need a lot of chips for it, and making those chips partly uses coal, but in it's relatively small quantities. The thing that I kind of feel about AI is, on the one hand, it will be far more material centric than people kind of expect, because it just is. The world is. People discount this stuff, and that's the point of the book. But I think the other thing that gives me hope is that I think if you were looking for various different challenges, so I am desperately uninterested in the LLM side of AI, the ChatGPT and all of this nonsense, because I just am. I'm sorry. I just can't get that enthusiastic about it.
Too old, Ed.
Yeah. I'm just too old. However, the side that I am interested in is, for instance, recently DeepMind, the Google bit of AI, they discovered various different ways to it's protein folding, basically. So they were able to anticipate how different proteins would form. This is a challenge that mainstream science has spent so much time trying to work out. Then I think even more recently, they came up with millions and millions of different entirely novel crystal formations, how you make crystals. Now, all of that stuff, just different crystalline forms, different kind of molecular forms, that if you were looking for some sort of thing which is potentially going to revolutionize the world, it's stuff like that. Because if you think about what's happening in labs, for instance, when people are trying to work out, whether it's new medicines or whether it's that they're working out a cleverer way of squeezing lithium out of a rock, it's experimenting with different types of crystals. And historically, people have just gone into the lab and they've just tried to come up with the best thing they can think of. But if AI is able to come up with millions of these things, and I think humans so far have only been able to come up with either tens or hundreds of thousands of novel crystal forms. If AI can do that, that is totally transformational. Then potentially we do have a way of reducing our energy consumption in the future. I think for every extra 10% of energy demand that AI will be responsible for, I think it will also be responsible for massively reducing energy demand by making all of our various different processes better. But that's not the ChatGPT side of things that most people are most excited about. And so I don't know how much that's costed into the market or not.
Isn't this, though, this is kind of the fundamental issue, is energy, because as you're saying, the economy is energy transformed. And the problem with net zero to an extent is that we're kind of kidding ourselves on that we can use less energy without reducing the quality of our lives. And the problem is actually the only way out of this is through. We need to find ways of making energy less damaging. So basically we need to have exponentially more energy with kind of whatever the opposite of exponentially less environmental consequences, as opposed to the approach which is kind of, well, replace everything with something somewhat less efficient, but then all that ends up happening is that we, I guess, stagnate.
The point being that almost all economic growth, great periods of progress have been made during periods of cheap energy. And so if you go through a process where you make your energy more expensive rather than cheaper, you can't really expect to have very fast growth as a result. And you can pretend that you're having fast growth because you're spending so much on the transition, but it's not real growth.
Economic progress is energy deployment. It's deploying more energy to do more stuff. That's what we've done. When every industrial revolution through history has been about getting more energy and doing more things, whether it was kind of water wheels or whether it's using coal or whether it's using oil or whether it's using nuclear. We've been on this kind of trend of getting ever more energy out of the different fuels that we're using. And the thing that happened in the 1970s, kind of 60s, 70s, is everyone got a bit scared of nuclear, understandably, given the accidents that you had there. And everyone got kind of scared about just the environment. And again, understandably, when you look at some of the conditions back then. Nonetheless, if you're looking back at our kind of economic history and looking at kind of, when it was that we suddenly saw our productivity starting to diminish, I don't think it's a coincidence that it was in that period where we started to fixate on trying to reduce our energy consumption around the world. Yes, by all means, we need to kind of do stuff with fewer emissions, but the idea that we need to do less stuff, which is kind of what is implied by deploying less energy, that to me is quite tragic. I think we need, as John was saying, we need to have way more energy. We need to have energy abundance. The question, of course, is how we can do that in a way that isn't kind of massively environmental.
The answer is nuclear, isn't it? I mean, there is only one answer.
Yeah, I think a big part of it is nuclear. But I think it's just that this association and extra energy is bad. That's been the thing that's sunk in. I think, since the kind of Jimmy Carter days, the energy is bad has just sunk into I think throughout the corporate world to some extent as well. No, energy is good. But it needs to be a cleaner form of energy that doesn't actually, ruin the planet. But we need more energy. We need to do more stuff because the more energy you have, then at that point, the potential is kind of limitless. You can have as much water as you want. You can have as much materials as you want. You can do anything at all. But until we have that limitless energy, and the problem is, of course, nuclear is massively expensive, and we need to find a way of confronting that. But we could. If only we had this started with the mindset of we need to do more stuff rather than we need to do less stuff. And it's been that let's do less stuff that's been the dominant kind of mindset in the last kind of 30, 40 years.
Of course we may, and we have one podcast guest who's been on a couple of times who tells us we don't need to worry about any of this because it won't be long now that we can just beam solar power direct from the sun, from space through a series of mirrors direct to the Earth, and there's nothing to worry about anymore. Yeah, it does, but through the mirrors. With a mirror, so it beams down directly, and we didn't completely understand it. Do you understand it completely, John? At the time, no, I didn't either, but I kind of pretended to do.
It's nice that people are thinking of these ideas, though, isn't it? I think it's interesting ideas.
Right, we better move to another quote, and we're not going to get the questions. Which we do your quote next, John?
Well, we did already touch on passive investing, but this is interesting. This is Adam Smith's view on basically shareholder companies. So the companies were used to listed companies. They're called joint stock companies in those days. And he's actually not a huge fan. So he says the trade of a joint stock company is always managed by a court of directors. And this is frequently subject in many respects to the control of a general court of proprietors. So that's your board of directors and your shareholders. He says, but the greater part of those proprietors seldom pretend to understand anything of the business of the company and give themselves no trouble about it, but receive contentedly such half-yearly or yearly dividend as the directors think proper to make to them. And he says, but the problem is, the directors of such companies, being the managers of other people's money rather than their own, it cannot be well expected that they should watch over it with the same anxious vigilance with which the partners in a private partnership frequently watch over their own. Negligence and profusion, therefore, must always prevail more or less in the management of the affairs of such a company. So basically what he's saying is that the problem is, it's kind of like, it's a classic economics problem where the owners of an asset and the managers of an asset have different incentives. So the owners just want the money that the asset generates, and the manager just wants to do the least amount of work they can possibly do while satisfying the needs of the owners. And what I think is interesting about why is this kind of relevant today is because increasingly the shareholder class actually is kind of absentee landlords. You know, this has been going for a long time. Like everyone in this room, I don't know, I suspect that actually probably more people in this room are slightly active investors than the average population. But your average person just pays a bit of money into their pension every month. The money in their pension gets handled by money managers, but a lot of the time now that money just goes straight into a passive tracker of the type that James was just talking about. So money just flows into the biggest companies with no real interest as to what those companies are doing, whether there are better options for the money. And the problem with that is it gradually undermines, or you can argue that it gradually undermines market efficiency. And market efficiency is basically the principle that if you take everyone's opinions, then the average averages out to be roughly the correct price for a company or for an asset. Whereas with passive investment, it's more like you get one person's opinion and then everyone else is following them. And so the market becomes horribly skewed towards one set of companies, such as the mega techs. And I think that this is not necessarily what Adam Smith would have had in mind as being the best way to efficiently allocate capital and human resources.
But how do you fix it, John? This problem has been around since he had this original insight that if you have an awful lot of owners of a company, you automatically give the power to the manager of the company rather than to the shareholders, right? So that's managerial capitalism, right? We've been worrying about that for decades. But it hasn't changed, and there's been all sorts of conversation. I've written a book about this myself, about how to give power back to the shareholders and how to get shareholders to use the rights they should have to do more than just accept dividends, and nothing ever changes.
It's a really tricky issue. I think it's one of those annoying subjects where it's more about just having to, government and population has to stay on top of where the most likely abuse of power is. So at the moment, for example, so you've got there's basically three big passive fund providers. So you've got BlackRock, Vanguard, and State Street. And then also underneath that, you've got three big dominant index providers. So not only do you have a concentration of power among the asset managers, the indexes that are constructed that these funds follow and that they pay license fees to use are also dominant. So I think it's S&P and FTSE Russell and one of the other ones. So you kind of got this agglomeration of power at the top of the market, and they are almost like a toll road through which all of our money goes, and they take their wee cut and they get very well off it. And it matters, but it's not obvious because they're technocrats. Like Larry Fink at BlackRock will occasionally stand up and say something semi-political, But most of the time, they understand that their position depends on them not being political and not being overtly influential. But, whenever you've got, one company owning, say, some people have started to write papers wondering, is this undermining competition as a whole? Because, for example, like in the airline sector, almost every airline is at least, I think, is about 20% owned by BlackRock, say. And then you start to think, well, wait a minute, well, if BlackRock owns 20% of the overall airline sector, then doesn't that encourage them to say, well, it doesn't matter if Ryanair's better or if EasyJet is better. And actually, the good thing would be is if they all colluded a bit to set prices, because then the overall airline sector would make higher profits as a whole. Now, that's a very contentious view. And personally speaking, I don't think that anything that overt is happening. But the point is you kind of erode capitalism and, as I say, the kind of
and we know what Adam
allocation of
Smith felt
capital.
about that. Oligopolies and monopolies and people from the same business meeting together in crowded rooms to discuss price fixing.
Exactly. I mean, the Wealth of Nations is basically a massive diatribe against monopoly-type arrangements. And I think it's more that. It's almost like a game of whack-a-mole. And you do see it. I mean, obviously, governments are starting to look at regulating the big tech companies harder, for example, because, and I guess that's just part of the whole game of, if they get ahead and then the kind of population gets ahead. Because we spent lots of time being distracted by arguments about network effects. But then we kind of ignored the fact that Facebook just went over and bought Instagram because that network was getting more popular than Facebook. So that was like a red herring. So I think that, it's more like an arms race between governments and populations and corporations.
Does anyone who owns shares ever go and vote at an AGM?
Well done.
Very engaged of you all. Right.
How could you get more people to do that? At the end of the day, even if you own Tesco shares and you actually do individually own Tesco shares, it's a lot of work.
But it shouldn't be a lot of work. You can gamify all this stuff, right? And one of the things that a lot of people have been talking about, and I've written about quite a lot, is the idea that it's possible for your pension provider to give you the ability to use every vote and every fraction of vote that you might have relative to the shares that you hold in your pension portfolio, and that you should be able to go on a website, see what that company does, see what votes are coming up, and just click through. But of course, this would ruin everything for the managers and ruin everything for the fund managers who like to have that kind of control.
Can I ask a question? Did everything just start going wrong when we had kind of unlimited liability? And would everything just be better if everything was a partnership? Would that be possible?
There is an argument about that, definitely. And actually, that's one of the big arguments, I think, in the Wealth of Nations, although I haven't read enough of it to know.
I know Adam Smith was very, very suspicious of the idea of bringing in limited liability. Yeah. Very suspicious. But on the other hand, it's the idea of not having liability that allows people to continually innovate. It's very hard if you say to people, if you go ahead with your brilliant idea and it fails, you're going to lose everything. Yeah. Who's going to go ahead with their brilliant idea? So the limited liability company, if you look at it like that, a lot of people think, and I agree, was possibly the greatest invention of all time.
And coincided with all the industrial revolution.
Because it allowed people to suddenly go, okay, I can have a go at this and I'll only lose what I put in, and they'll be able to have another go and another go and another go, like take risks, they can innovate, etc.
It's called America.
Right.
I suppose it's fair to say, if the investment banks had still been partnerships before 2008, then 2008 probably wouldn't have happened, or it wouldn't have been as bad as it was, if they were all on the hook for everything. But then that is that argument about risk-taking versus risk aversion.
Do you know how many people went to jail for abusing the rules on bank leverage?
I'm going to guess net zero.
But much more importantly, why? Why did they not do any perp walks? Why was no one even prosecuted?
Well, nobody broke the law.
No, because the idiots were the bureaucrats. The ones who were in charge of policing it were the ones who caused it to happen.
And then you can also argue the poor buggers that get done for LIBOR about 5 years later, when this all exploded into the public, perception, were scapegoats. I know that's slightly off topic.
I think what happened in LIBOR is probably a little much for this panel and podcast. So we're going to go to our last quote. James, make it snappy because I'm running out of my question time.
Right. There is no art which one government sooner learns of another than that draining more from the pockets of the people.
Would you like me to read it? Because you haven't got your glasses on.
I've got
have
my
you?
glasses. It's a miracle I got through that. It was one smudge going to another smudge and a shorter smudge in the middle.
There is no art which one government sooner learns of another than that of draining money from the pockets of the people.
And remember that quote, because it's going to become incredibly important over the next 10 years. So this country's debt to GDP, just prior to the financial crisis, was about 36%. And it's now around about 100%. Now, if you divide up the increase in government debt by years, that's an increase of about 4% a year. Do you remember the economy roaring along at 4% a year? Probably not. In the last 2 years, the US government has borrowed $3 trillion, and from that managed to generate $2 whole trillion of nominal, not even real, GDP. So it turns out that government expenditure is incredibly unproductive and does nothing really, even in the short term, other than add to the indebtedness of the country and therefore the future interest bill. Who knew? But this really matters because basically under our watch, without anyone really noticing, by the way, this data I gave for the UK excludes bailing out the banks. So it's got nothing to do with the financial crisis. This is just the fact that they thought, well, since we've had a financial crisis and no one seems to be watching and interest rates and yields have gone really low, we can borrow up a storm and spend lots of money gerrymandering and buying votes and all the rest of it. Although there's not much evidence it even works in terms of buying votes. But the fact is that when the government takes over half the economy, which is the case now in the UK, and in fact, if you exclude England, it's more than two-thirds of the economy in all the other parts of the UK. So the economy, the private sector economy, don't forget, government doesn't spend any money at all. It just redirects private sector money and redistributes it to worthy causes that are reliant on government handouts and pretends it's their money. So government takes private sector tax revenues or future tax revenues if they've borrowed the money and gives it to other people and says, we gave it to you, not the other people who'd actually earned it. Now, this is a major problem because when you get to the stage where you have far too many people receiving as beneficiaries of these payments, they're obviously disinclined. As I think the great American agony aunt, whose name escapes me for a second, said, the givers have to say when enough is enough because the takers rarely do, for which we never do. So we've got this massive problem. Bill Bryson was pointing out in his book about his childhood that in 1957, I think it was, Americans were as happy as they've ever been. And it's been downhill since then. The Encyclopedia of Mental Disorders, the big dictionary of mental disorders in the US, had 104 different psychiatric problems in the 1950s. It now has over 400. So what has happened is that everyone has become much less happy because they've become much more mentally ill.
How are you taking this back to the tax take?
Because
and I'm going with it so far, though.
what makes many people mentally ill is the fact that it is a gateway to personal independence payments, which are far higher than boring bog standard unemployment payments. So unemployment benefit is very, very low. But if you can add some interesting tassels to your unemployment, then not only do they tell you don't have to look for a job, you'll get more money. That's very hard for people who are given free money for doing nothing to turn around and say, actually, one of the reasons I'm feeling low is I haven't got a job. I better go and get a job, particularly if they start by taking a job lower down before they work their way up, where the effective tax rate, because they're not making much more money than they got benefits, is very punitive. So we've got a situation where 9 million working age adults in the UK are not in work and not looking for work.
And this is a result of their incentive structure.
Yes, but it's an unaffordable incentive structure. So the real point I want to make is that you could just about keep this thing going as long as interest rates were just about zero, because the interest payments on the debt was never coming due, like a console, and the interest payments were super low. We could kind of keep this gig going. And the politicians went, yeah, let's buy another election if we can.
Okay, well, James, look at it this way. There is no way that state spending is going to fall. State spending is definitely going to rise. Certainly of this government and probably the next government, there is absolutely no way that we're going to see a fall in overall government spending. It's going to go up. How's it going to be financed? Where do you think the tax rises are going to come?
Well, initially the tax rises will come all over the place, but don't forget that we already have a government that's spending 48%, I think it is, percent of GDP. Mm-hmm. Tax revenues are more like about 34%. So the rest is debt.
I mean, this is interesting, isn't it? Because certainly in the UK, all nations seem to have their own limit of the amount of tax that they're prepared to pay. And if you look at the history of the UK, we kind of top out at 37% of GDP. As taxpayers simply refuse to pay more.
Yeah, I mean, there comes a stage where if someone else is taking money off you, then you're okay with 10%, you're okay with 20%, probably okay with 30%, you're okay with 40% as long as it's a marginal rate, and at least you can. But there comes a stage we just go, or I won't bother working. So if you have all the people who aren't bothering working being paid for by all the people who are bothering working, but then the people who are bothering working turn around and say, I'm no longer incentivized to work.
Or you leave. I mean, here we have this growing problem in the UK of our very rich leaving and our young leaving.
I'm not sure they are very rich, but there's some very rich who temporarily popped over and then went, you're changing my tax status, I'm off, which is interesting in itself. You know, if you want to lose rich people, you increase the tax. And they either stop working, move abroad, like the brain drain from the Labour period, or if they're foreigners, they go, well, if they're really rich, they can be living anywhere they want.
What everyone really wants to know is if their capital gains tax is going to go up.
Well, if you look at the list of taxes that people don't mind going up, it is exactly the same as the list of taxes that most people don't expect to pay. So it's higher rate taxes on high earners, capital gains tax, and corporation tax. Yeah. Of course, what everyone is still forgetting is that that the art of taxing is to pluck the goose with the minimum amount of hissing. And if you basically keep plucking the goose and the hissing gets too loud, you'll end up losing as well. So, corporation tax goes up. What, you think companies won't put their prices up to compensate? Suddenly you're going like, oh, my tax hasn't gone up, but my cost of living has. You start, taxing higher earners. Higher earners start saying, well...
Won't work that hard. Okay, on that happy note, let's have questions.
Do you not think the growth of index funds is because most fund managers are skeptics, like the two of you, and therefore miss out investing in some of these incredible businesses, which frankly have benefited from the internet and smartphones and all this sort of stuff. And these are all really driven indexes forward. And most fund managers haven't had enough investors in these companies and are therefore underperformed. And therefore, most investors say, you know what, we're not going to put money into active fund managers. We're going to invest our hard-earned savings into index funds.
So the question is really, are passive funds there to protect investors from fund managers? Yeah. James? John?
My opinion on that would be that it depends whether the movement into ETFs is sort of cyclical or structural, in the sense that we went from a position of not having much money in ETFs to now almost all the money's in ETFs. And whilst the money's still increasingly going into ETFs, it will keep pushing ETFs' performance ahead of active fund managers. But once that submarine surfaces and flops onto the surface.
And what would make that happen?
Well, we'll get to the tipping point. The trouble with tipping points is it's easier to say there's a tipping point coming than to say when it is or where it is. But if that tipping point comes and it turns out that active fund managers seem to have quietly been performing very, very well, the Russell 2000 has done nothing, the S&P equal weighted's done nothing, and the S&P and NASDAQ have gone through the roof. But the last time that happened was in 1999. And then 2000 happened. And by the end of 2001, the Russell 2000 and the S&P equal weighted had massively outperformed the S&P and NASDAQ. So the problem with taking views at any moment in time and then extrapolating that will happen forever is that by the time everyone agrees that will happen forever, that's the day the market tops and it all changes.
Yeah. John, did you have something to...
Oh yeah, no, I think it's a good question. I think it's a good point, and I think passive investing is a good thing. I mean, to be very clear, I mean, when we were at Money Week, we were among the first to go on about how passive investing is a lot better than active investing because active managers. And to be fair, I don't think it's because of what people are investing in. I think it's more to do with the costs. Passive investing is much, much cheaper than active investing, and certainly in the last 5 years or so, there's also been a regulatory move to focus on costs, which has also persuaded financial advisors and pension funds, etc., to focus very much on cost and therefore essentially price out active managers. So I don't think there's anything bad about that. But it is more that issue of eventually going to chase stuff up too far. And again, it's interesting that the US has outperformed to the point where people now assume the US has always outperformed. Actually, that's not the case. The US was underperforming the UK as recently as kind of 2004, 2005. So it's more, this has been a long cycle, which I would say is also to do with 0% interest rates. But yeah, passive is a good thing, but you can have too much of a good thing, basically.
Fair enough. More questions? Got one right here in the front.
If Adam Smith were alive today, do you think he would be an advocate or an opponent of the concept of carbon taxes?
Ooh.
It's a really good question.
Yes.
Do you think so?
This is the shortest answer I could think of that didn't have a comeback.
I don't know. I mean, I probably don't know enough about Adam Smith to give a really kind of considered answer.
I mean, it's always a mistake to try and extrapolate from people, what would they think today?
Theory, carbon taxes are so economists love them so much because they solve everything. But they just, we our biggest carbon tax in this country, we keep cutting it. It's fuel duty. By far and away our biggest carbon tax. James was talking earlier about the taxes that people say they're willing to pay, the ones they think they're not going to ever. They think other people will pay. But the issue with carbon taxes is often these are the things that people notice. And that's the difficulty, is it solves everything. It's great. It's amazing. It solves everything if you can put a price on carbon. But show me a country that has actually been able to implement it properly and hasn't gone through exactly the same issue that we're going through. So I imagine, I don't know whether, would Adam Smith have been able to kind of see all the way through that?
I mean, I think probably not. I mean, obviously, as I say, it's very high. I'm very against saying what would so-and-so who's been dead for 300 years think about.
I don't think he would like it.
He spoke a lot about taxes, and he wrote about taxes relentlessly, and he was very, very clear that taxes should be simple, straightforward, completely understandable, easy to pay, all this kind of thing.
Isn't this before there was even income tax?
Yeah.
And
I suspect that a carbon tax would actually fail on pretty much every single one of his criteria.
Because he's very pragmatic. It was like super pragmatic.
Yeah, he just wanted taxes to be simple, straightforward, easy for anyone to pay at any time. And obviously our tax system is absolutely not that anymore. And if you were to extrapolate what he might have thought, I think he would look at our tax system today and just say, well, that economy is destroyed. Absolutely destroyed, because a tax system of that length and complexity creates such appalling incentives and difficulties and such an overlay of admin hell for everybody that this can't possibly work. I think he'd be horrified already, and if you then said to him, how about a carbon tax, I think he would turn over in his grave so many times.
Well, he wondered aloud at the amazing fortuitousness of an economic system that allocated resources productively and efficiently, even though no one was doing it. And now we have a system where we have people allocating resources deliberately and aggressively, unproductively and inefficiently. I think he'd be horrified.
The invisible hand is not going to work under these circumstances. Right. I'm not going to do any more questions because I want to ask the panel one last question before we end, which is, because technically we should be talking more about investment. If you could just make one investment today, only one, what would it be? James? Quickly.
How long's it for?
10 years.
Come back to me.
John?
I've been punting UK equities for a while, and I still think UK equities are a good bet because Britain spent so long being detested by the world's fund managers, and that's very recently, probably only this year, started to turn around. And now they've all got the excuse for saying, oh, well, I wanted to wait until the Tories were out of government. So I think that'll continue.
Okay, UK equities, thank you. James? You can't look at Ed, he's not an investor.
All right, okay. Well, silver.
Oh.
Gold's gone to new highs. I'm a little bit worried about gold because gold, if you look at gold compared to the price index, it's looking awfully high. And if gold's supposed to protect real wealth and stuff, or be a real reflection of inflation, then you'd really wanted a discount to that. But silver historically tracks gold, not very tightly, but it does sort of track it. It usually goes to a premium to gold near the top. That's how you know it's a top. And at the moment, it's at a substantial discount.
Okay, we're getting old world stuff here. UK equities, silver.
A lot of silver and solar panels as well. So, yeah.
Ed, you don't have to answer this one, but
I can't. Mainly because I don't know. Theoretically, I'm not allowed to, but also I have no clue.
You have no clue. All right. Well, I think that's a great place to end with a don't know, because that's how we all feel about most things, isn't it? Thanks for listening to this week's Merryn Talks Money. If you like our show, rate, review and subscribe wherever you listen to podcasts. And keep sending your questions or comments to merrynmoney@bloomberg.net. This episode was produced by me, Merryn Somerset Webb. It was produced by Summer Sadi. Production support and sound by Moses Andem. Special thanks to John Stepek. Thank you again, John. James Ferguson, Ed Conway and Blair Barrows at Panmure House. And be sure to follow me and John on Twitter or X at MerrynSW and at John_Stepek. Thanks for listening.